At the foundation of the global economy is something surprisingly basic. It is essentially a simple piece of paper, an IOU from the United States government, known as a treasury bond. When you buy one, you lend the government cash, and they promise to pay you back with interest. Because the U.S. economy is so large and reliable, banks, foreign nations, and even your grandparents' pension funds treat these specific IOUs as the single safest place on earth to store their wealth. But there is a catch. Right now, the United States has issued $34 trillion worth of these IOUs. That number is so large it breaks the human brain. If you spent $1 million every single day, it would take you 93,000 years to spend $34 trillion. This total is currently accelerating, growing faster today than at any point in American history. To understand how we arrived here, we have to look backward. After World War II, the national debt was high, but it was highly manageable. The post-war economy was booming so rapidly that the country easily generated enough wealth to cover its obligations. Things changed in the 1970s. The U.S. entered a severe economic crisis. Inflation surged, and the government ended the gold standard, which had previously tied the dollar to physical gold. Without that anchor, politicians gained the flexibility to borrow heavily. They used that flexibility aggressively in the 1980s. The government implemented sweeping tax cuts while simultaneously increasing military spending. The combination tripled the national debt in just 8 years. Then came the 21st century, bringing a rapid series of incredibly expensive emergencies. The wars in Iraq and Afghanistan cost over $2 trillion. The 2008 financial crisis required massive bank bailouts, and the COVID-19 pandemic triggered over $5 trillion in emergency relief. Through every single crisis, politicians assured the public that the borrowing was absolutely necessary and that they would pay it all back later, but later never arrived. The immediate mechanical threat to the budget is the annual interest required to maintain that debt. This illustrates an adjustable rate mortgage. If you have a 2% loan and rates rise to 5%, your house hasn't changed, but your payment skyrockets. This is exactly the government situation right now, forced to refinance its debt at significantly higher rates. The United States is currently paying over $1 trillion a year strictly in interest. That money isn't paying down the balance, it is just keeping the account current. To put that in perspective, America now spends more money paying interest to bondholders than it spends on its entire military budget. Every dollar absorbed by that interest payment is a dollar removed from the real economy. It is money that cannot be used to repair crumbling bridges, fund local schools, or support healthcare clinics. Fixing this math requires doing one of two things: raising taxes significantly or drastically cutting funding to popular social programs like Social Security and Medicare. Politicians avoid these solutions because suggesting either one practically guarantees they will lose their next election. The incentive is to look the other way. Instead of solving the math, lawmakers regularly argue over the debt ceiling. This is supposed to be a legal limit on how much the country can borrow, but rather than enforcing discipline, it gets used as leverage. One political party holds up the vote to raise the limit, demanding concessions from the other side. The result is a nerve-wracking, highly televised hostage situation. It causes market panic and threatens government shutdowns, but it ultimately does nothing to stop the debt from climbing. If the political theater goes too far and the U.S. fails to honor its debts, the domestic damage would happen in hours. Federal contractors would stop getting paid, military salaries would freeze, and millions relying on safety net checks would be left empty-handed. The damage would rapidly spread globally. Because the entire world relies on the U.S. Treasury bond as a risk-free asset, a broken promise would shatter market confidence. Stock markets would plunge, and everyday loans, like your mortgage or a small business line of credit, would become painfully expensive. A reasonable person might ask, since the Federal Reserve controls its currency, why doesn't the government just print enough dollars to wipe out the debt? Simply put, printing money doesn't create new wealth. It spreads existing value across more dollars. If the U.S. printed trillions to pay its debt, it would trigger massive inflation. Your groceries, rent, and gas would become unaffordable, which acts exactly like a severe hidden tax on your savings. While it is technically possible, printing money on that scale would permanently destroy the world's faith in the US dollar. It would be a direct path to economic self-destruction. Interestingly, the scenario that keeps serious economists awake at night isn't a dramatic overnight default. They worry about a quiet, grinding loss of global confidence. This diagram shows a debt spiral. If foreign investors decide US debt is risky, they demand higher interest rates. Those higher rates make debt more expensive, forcing the government to borrow more money, pushing rates even higher. The only relatively painless way to break this cycle is through explosive economic growth. If breakthroughs in technology rapidly expand the economy, the country can generate enough tax revenue to carry the debt without making brutal cuts. The math dictates that an adjustment is coming. The only question left is whether the United States will make deliberate, difficult policy choices on its own terms today, or wait for a severe market crisis to force its hand tomorrow.